at the bottom of the liquidity cycle. It's like, okay, this is going to give you a very high probability, no certainties, that this is a low. So the liquidity cycle is going to change. So that's the macro forward looking. In 18 months' time, are we going to have less money in the system or more money? The answer is 100% chance of more money. Because if not, we've blown up the entire world's economy.
Hello and welcome. This is the Daily Crypto. We are currently enjoying a short bull run, but are we already in a recession? Will it still get worse before it gets better? How do we make the most of the bear market? Keep watching to find out as we answer these questions with the CEO and co-founder of Real Vision, Raoul Pal. We dive right into the heart of the situation and ask, are we in a recession?
Yeah, probably. I know everyone on Twitter's flinging poo at each other, whether it's a recession or not, and the government stepping in. But basically, 2 quarters of negative GDP, not good. Usually that's given a 100% chance of a recession. We haven't had confirmation yet from things like the ISM survey, the Institute of Supply Managers survey. That usually drops to about 47. I'm expecting that in the next month or two. And then we'll be definitely there. So we're there or thereabouts. It feels that way. The markets have traded that way. We're seeing job cuts coming. We're seeing a lot of evidence, and even the bond market's starting to tell us that. So it feels that the recession is here.
So in very general terms, what are the 2 or 3 indicators that Raoul thinks a layman who is not a macro expert can look at to get a reasonable understanding of the macro situation?
Firstly, the thing that gives you the best guide is something called the ISM survey. And you can Google it, you can find it, it's publicly available. And that basically, anything above 50, the economy's expanding. Anything below 50, it's kind of stalling, and anything below 47 is a recession. And that's been going since about 1947. It's an incredibly good indicator and really useful. So think of it as a kind of weekly version of GDP. So that gives you a very quick ballpark. And what's really interesting that no economists figure out, and I don't understand this, is it goes up and down. It's cyclical, right? Economists have linear projections. It's like, really? You can show a small child a chart of GDP and they go, well, it goes up and down. So what it does, if you see it going down and crossing 50, we're likely to be headed into a weak patch or a recession. If it's coming up from the lows, we can start looking forwards. So that's a really simple guide. The other way is the bond market's usually very good at this. So once yields start falling, bond markets are generally derive their price action from 2 things: GDP growth and future inflation. So if bond yields are rallying, it's saying that GDP is probably slowing down, i.e. there's a chance of stimulus to come and bonds look a safe haven. And secondly, that inflation is likely to come down in the future.
With so many people now starting to understand all this, is this a self-fulfilling prophecy? What comes first here when we see the NASDAQ price in the charts?
Yeah, does technical analysis lead to price action or does it not? All I know is if you listen to Stan Druckenmiller over the last 20 years, every time he gives an interview, he says, you know where the economy is by looking at the internals of the stock market. What does he mean? It means things like consumer discretionary stocks versus utilities. If the economy's slowing, then discretionary stocks, i.e. the discretionary spending, tends to fall. Utilities are the things we have to have, so they tend to do well. They're all correlated with the business cycle. The business cycle, I've got business cycle indicators going back to 1870. They still work. So even though more people might look at them over time, I still don't think it's necessarily the driver of price action. If not, you would have seen more assets priced in the same move. But we haven't, right? We've got bonds up here, haven't priced in much of a weakening ISM. And then we've got tech stocks, which are at the bottom, which are priced in a massive amount of weakening.
It would seem that if there is a lack of consensus on the Fed pivoting or a long-term trend line downward on interest rates no longer being a viable predictor, what should be a kind of reasonable road to consensus over decades?
There is no consensus because there's a group that extrapolates the recent trend and says that's going to continue, and there's a group that extrapolates a mean reversion. Now, the question is here is more complicated because we've got these supply issues, we've got onshoring, we've got other things that are muddying the equation. And what we've got is this big debate. So myself, David Rosenberg, and maybe Urian and a few others kind of think we probably mean revert because of debt, demographics, technology, that inflation's not a long-term issue. But there's a whole other group who I really respect who are saying, no, you're dead wrong. Inflation's sticky, it's here to stay, and it's a big problem. And we won't know, and this is the beauty of financial markets, right? It's game on now. We've got the game, we place our bets, and we'll find out who's right and who's wrong.
But it does feel like many prices have either peaked or are starting to come down. And Raoul adds that that is really what matters here more than the actual inflation level itself like crypto. But is that the more important perspective?
Marginally, all prices are falling, except, well, even oil's fallen, but not as much as others. But stuff like copper that's very economically sensitive, been decimated. And we've seen that in agricultural commodities, we've seen it in all commodities. Now, Elon Musk tweeted out yesterday, somebody who'd been talking about the inflation in his supply chains, said, we're seeing prices peak. Okay, he is a consumer of a lot of different raw materials.
That's right.
And he's telling us this. And we're seeing that all over the place. So, okay, so why is it at 9% now? Well, inflation is a lagging indicator. It looks back over prices. So still we're seeing some companies pushing through price increases of commodities that they bought 6 months ago that they've turned into cereal boxes that they've now put on the shelves, right? So it's a delayed process. And eventually the delay comes the other way. The other big delay is rents, because the housing market is slow to move. It's not like equity markets that can move very quickly. So as the housing market comes down and mortgage rates come down, rents will slowly come down. But that can take a while. And it's the same with wages. So we're now just starting to see all the tech companies laying off people, all the crypto companies laying off people.
Raoul indicates that we might also get to negative inflation. Even with the money printing, is it still possible that we are going to end up in a deflationary environment at some point in the next 24 months?
Right. So, one of the things people talk about agriculture right now, we're going to have this food crisis. Step back and look at the inflation-adjusted prices of agriculture for the last 50 years. It's gone down. Why? It's gone down, even though the population of the world has doubled, it's gone down because of technology.
Technology, absolutely.
Look at what happened with the shale revolution. Why did oil fall so fast in kind of the 2016, 18? It's because shale was a new technology. So what people are saying right now is none of the supply issues can be solved by technology. But because you're closer to it and where you're based, is that everybody's trying to solve it. So everybody's trying to solve, because there's supernormal profits in solving supply issues. So you focus your attention and your capital on solving it and you'll make money.
What the central bank did was to implement fiscal stimulus. They knew the economy needed fiscal stimulus, which Raoul thinks the US and all the economies need to build the green infrastructure, technology infrastructure, and all the things that have been abandoned for so long. In a boom time after the recovery of the economy, Raoul adds that we might want to cap yields and say we don't want this business cycle that we have just had in which a boom-bust comes around. In that case, maybe they cap them at 3% or 2.5%. At this point, Raoul indicates that what they would have been trying to do is have inflation running slightly hotter, but not much more than your yields. Those negative real rates mean you should get a productive return on assets if you do it properly, he adds.
Properly. So I think it's coming. Europe is basically there now. Japan's been doing it for a period of time. And it's also been a function of demographics. They can't allow debts to rise because you blow up the whole system. And the European banking system's a mess as well. The US banking system's better.
So how does this all affect crypto?
There is passing correlation because liquidity. So if we think what causes the correlation that we see right now, well, it's actually stopped, but the NASDAQ and the S&P, right? Liquidity and inflation, two big macro factors. So the liquidity cycle, call it global M2 year on year, drives the crypto cycle. Because it's liquidity, right? There's how much money's in the system. Can I buy more of that stuff or less of that stuff?
What does liquidity in the system mean exactly? Do we think of it as manna from heaven, where the Fed sprinkles cash on us that would allow us to buy more of these risks on assets?
Exactly. So M2 is money supply. How much money's in the system? Therefore, it's easier for you and me to have money, easiest to put it in the market, right? Boom times, there tends to be more of this stuff, but they tend to really ramp it up during a recession because they're trying to get the economy, give it more money.
He continues.
Of these parameters, stuff like the 60-month exponential moving average, the 5-year moving average, exponential moving average, all of these measures, the most oversold RSIs in history, everything all happened at the same time. At the bottom of the liquidity cycle, it's like, okay, this is going to give you a very high probability, no certainties, that this is a low. So the liquidity cycle is going to change. So that's the macro forward looking. In 18 months' time, are we going to have less money in the system or more money? The answer is 100% chance of more money. Because if not, we've blown up the entire world's economy.
Thanks for watching this video. Would you rather hold Bitcoin or Ethereum? Let us know what you think in the comments section below. Don't forget to like, share, and subscribe to our YouTube channel. See you on the next one. Until then, bye.